Mark Sachs.
Hey, thanks so much. And thank you for having me here today. Just really quickly, I just wanted to go over our disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or our subscribers are for educational demonstration purposes only. Our Right Line Trading takes no responsibility for any participation by visitors or subscribers within any of these markets for any profits or losses that may be incurred. Participation in trading, as you all know, involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, participation in these markets is not appropriate for everybody. You may want to do your own due diligence, and those of us at Right Line Trading are not registered financial advisors, nor are we licensed commodity trading advisors. Now, with that said, as fast as I could get it out, let's get into the heart of the talk. A little bit about myself quickly. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I published close to 15 peer-reviewed articles in first-year journals. I've been involved in the financial markets for over 20 years. I spent the first half of my life in the library, reading book after book, looking at video after video, and really trying to understand how price moves in the financial markets. Now, Right Line Trading software is a product of over a decade of analysis of price action, market structure, indicator algorithms. The software is based on mathematical modeling of closed systems utilizing multivariable equations. It's one of the fastest growing trading systems on NinjaTrader. And I just want to add that during my undergraduate work, I did mathematical modeling for the U.S. Navy, in which I helped optimize their underwater decompression schedules, which at the time was very difficult and very dangerous to come up from a really, really deep dive. And I'm moving kind of fast because I have so much material. I don't want to run out of time. And I don't want to take up anybody else's time either. So let me move forward here. And we're going to, I want to talk a little bit quickly about Unorenko bars. Now, we have modified Unorenko. The system works, that I'm going to show you, works on any type of candle. Time, tick, range, Renko, Unorenko. I just happen to really like optimized Unorenko because the settings can be changed for any financial market, any individual stock, any future, NASDAQ, E-mini, crude. It does not matter. Now, when you trade Unorenko bars, they obliterate price action, and they pull away some of the information you get in terms of who is in control of the market, bulls or bears. Now, there are many, many right ways to trade, and there are many, many wrong ways to trade. And I would never be so arrogant as to tell you that I'm giving you the only right way to trade. But I'm going to give you a different paradigm, a way to trade that essentially may be quite different than anything that you've heard before. Now, just to finish my last thought, with Unorenko, you cannot evaluate Japanese candlestick patterns, engulfing dark cloud cover, dojis, shooting stars, etc. You cannot discern between a rising and falling triangle or channels. So what you need in order to trade Unorenko bars, although you can trade time, tick, or range if you want, are powerful leading indicators to signal an entry. Now, the strength is they do filter out a lot of noise. And if you have powerful leading indicators, they really, I think, create superior trading opportunities. I mean, in my live trading room this week, we were up a ton of money. I have 8 trades, 7 winners, 1 loser. And the 1 loser I took was a perfect trade that didn't work, which happens all the time. And I don't have NinjaTrader open, or I would show you that we're up close to $1,000 in 2 days. And that's off my NinjaTrader back end. That's not supposition. I trade with Chart Trader Up. I trade live. I take all the trades. I call them out in advance. Now, I just want to tell you a little bit about the way I believe that the market moves right now. The market 30 years ago and the way it trades today are very, very different animals. 20, 30 years ago, you could trade divergence. You could trade using Japanese candlestick patterns. You could trade using, I believe you could trade divergent signals, if I did mention it. You could also trade Japanese candlestick patterns. But if you remember all of these things, that 400 years ago, the Japanese rice traders made a supposition when they created them. And that was that the power of each individual trader equaled the power of each individual seller. That's the same supposition that Elliott made and Gann made, and, and really, in a sense, Fibonacci made. They were trading in a market where that was true. But we know now that it is not true anymore, irrespective of Japanese candlestick patterns or any intrinsic waveform that may have been present in the market as a closed system. The thing that dominates market direction, irrespective of what you're trading now, is institutional money. And big money doesn't care whether you're sitting at a fib line, whether you're sitting at a doji, whether you're sitting at whatever. It's going to grab hold of the market, and it's going to move in the direction that it is pushed in by all this big money, by the banks, and by the big brokerages. So the only way that you can trade successfully, and the reason that I make so much money in our live training room almost every day, is because what we use are leading indicators that tell us the direction that the institutional traders are pushing the market, and also tell us when there is no institutional money present and we should stand down, because we don't want to trade with the small guys. That's when the market chops. We always want to be in the market one half step behind institutional money. Now, what we use, the core of the system, is our three-line indicator. And what it does is, now again, in order to create a leading indicator, it must do a multi-time frame analysis, because the higher time frames rule, not just in direction, but for many other forces and factors. In fact, if the indicator itself is just in any way, shape, or form analyzes price on your trading chart, it creates a dependent analysis and totally ruins the ability of the indicator to give you a great prediction of how price is going to move off the right edge of the chart. And that's all we care about, is how price is going to move off the right edge. We know that. We know everything. So let's take a look at our first assessment, and it's order flow. Now, order flow, and I know I'm moving through this a little bit quickly, but I have to, because I don't want to get caught without flat-footed and not finished. Now you can see this is a very difficult assessment to make. Here's the volume ladder. This is stack sellers, stack buyers. Every price level, whether it's a cent, a pip, or a tick, on a dome is going to have how many traders sitting at the bid and how many traders sitting at the ask. How many traders looking to buy, how many traders looking to sell. And the market delta calculation doesn't look at executed trades. It just looks at how many buyers on each side of the dome. And it comes up with a number. In this case, it's 29.85. Now, what it's trying to tell you is, because there's a strong overabundance of buyers on the dome, there should be buying pressure on the candle, and the candle's going to close to the upside. But it just isn't that easy, and here's the problem. Here's a positive 222. There should be buying pressure here, yet the candle closes down. Now, there's a distinct reason for this. Inside, here's the volume ladder. Here's this square, this green square, are stack buyers. Here's stack sellers. They do not have the power to predict anything. Nothing on your chart alone has the power to predict market direction. Only the higher time frame, or actually multi-time frame analysis does. Now, if we look at a chart and we look at all the market deltas above every candle, most analyses simply look at the absolute value of the change in market delta value. But it gives you no accurate prediction as to how price is going to move off the right edge, because you can get a down candle on a green delta and an up candle on a red delta. So if that's the case, how is market delta in any way predictive how price is going to move off the right edge of the chart? And this is how we've solved the problem, because it does have predictive ability. You just have to leverage the number in the correct way. And what it is one standard deviation's worth of data will always work. But the outliers, which are further out than one standard deviation, have a high probability of giving you a signal in which the candle closes in the opposite direction. Now, why does this occur at all? And the answer is really simple. This minus 220 tells you that there's an overabundance of sellers, yet the candle closes up. The reason is it doesn't tell you the aggressiveness of the buyers and sellers. And let's just say, for instance, that the price of this financial instrument is 50. Now, the buyers are willing to take 50.1. But the sellers, because they're so sure the price is going to go down, well, they're willing to take 49.9, 49.8, even 49.7. They're very aggressive sellers. So even though you have a negative delta, I actually did that backwards. You have a negative delta on an up candle. Here, what you have is very, very aggressive buyers. It sort of cancels out the fact that there are more sellers. So how do we configure this to make it, to give it predictive value? And here's how we do it. We look at the two higher time frames only. And that's what we do with all of these analyses. We don't look at anything that takes place on your trading chart at all. Trading a 2-minute, we look at the 6-minute and the 18-minute. If you're trading a 5 range, we look at the 2 Fibonacci higher numbers, 8 range and 13 range. If you're trading let's say a 610 tick, we look at the 9, whatever it is tick, the 2-hour Unorenko numbers. So the analysis is always based off the two higher time frames. We don't care what the delta value is of the candles on our trading chart. Then we place those values into a 15-period simple moving average. And because you get a smooth value over 15 candles, it throws out the outliers. So when both 15-period SMAs are sloping up, the bulls are firmly in control of the market. It means that only institutional money can do this. We, as the small traders, cannot create this alignment. When both 15-period SMAs are sloping down, the bears are firmly in control, and you've got tremendous selling pressure. And when the 15 periods are not in agreement, you're yellow, and that's when the small guys are in control of the market. The market's going to chop, and we don't want to trade. So now we have an absolute trading direction. And the fact is that the order flow line leads price. And you can see that price falls. The order flow line is going to turn green first. And the first up pivot is going to be our long trade. Now, we have a few other trading rules in addition to this. But what we do is we have an absolute direction that you have to trade. You have to trade in the direction that order flow is pointed. And the mistake I made today was I didn't do that. I was looking for a 12-tick first target. The trade went 6 in my direction and then abruptly reversed and gave me a loser. I would have, or I would have been 8 and 8. I made, it was human error. I didn't look carefully, and order flow was aligned in the wrong direction, and I got nailed. The other thing is, we always want to take advantage of these counter trend traders. We know that order flow is green. We know that price is going to rise. When we see someone taking a counter trend candle, one of the strongest things to do is take the next up candle, which is haloed in blue, and we'll talk about the halo in a second, but it's in the direction of order flow. We're going to run them over, and these sellers are all going to get stopped out. They're going to help push this move to the upside. Now, I don't believe you can call a top or a bottom. It's impossible mathematically because the institutions call a top or a bottom. And we all knew that the market can stay overbought or oversold for days, hours, days, weeks, or months, depending upon the time frame you're looking at. So we trade the trend, and we don't call a top or a bottom. As long as institutional money is involved in the trade, the trade can go higher and higher. Here's another example. Order flow turns first. First up pivot, and up you go. If you counter trend trade against the direction of order flow, the likelihood of getting stopped out is exceedingly high. Here's one more example. Long, no trading here. Short, long. Order flow leads price. It's coming off the two higher time frames. That's what makes it a leading indicator and so powerful. And those 15-period SMAs eliminate those outliers and create a really, really accurate assessment of buying and selling pressure in the market. Now, when it keeps changing color, price is going to chop. And one of the most important things about software is not only getting you into winners, it's keeping you out of trades and clearly defining chop for you. And as we add lines, you're going to see that it becomes super easy to define chop. I mean, one of the hallmarks of our software is the ability to sidestep the markets and eliminate losers. And I always ask my traders, what is the number one goal in day trading or swing trading? And almost always I get the answer is, well, to get winners. But that's not true. The number one goal of a swing trader or day trader is to avoid losers. If you avoid losers, if you trade with patience and discipline, and don't ever worry about FOMO, fear of missing out. If you don't take the trade because it's too risky and it goes 150 ticks or 150 pips or $25, it's not an issue. Because the next time you get that setup, it's going to blow up on you 4 times in a row. Take your perfect setups and your perfect alignments and sidestep, and try to sidestep 80% or more of the losers. Now, this is a little bit out of order here, and I don't know what happened to my. Hold on a minute. Now, I'm going to have to go back. I'm going to have to backtrack. The second analysis is momentum. And momentum, there's a lot of ways to utilize momentum. You can use Heikin-Ashi. You can use an oscillator, which is a really decent way of analyzing momentum. But we use MACD, the slope of the MACD, to analyze momentum. And we look at the 2 higher time frames only. We don't care what the MACD is doing on our trading chart. Now, really, the guy who invented this, his name was Alexander Elder. He wrote a book in 1996 called Trading for a Living. I mean, I kind of consider him my mentor, although I've lost track of him in the last couple of years. I corresponded with him quite a lot. But he developed what's called the triple screen method of trading. You have your trading chart, and then you have your 2 higher time frames that determine the direction of your trading chart. And every trade he took was based on his triple screen method. And in an era where trading was pretty primitive, We didn't have these sophisticated analyses that we did now. Because he used a triple screen method, and it's all defined in his book, the guy made millions of dollars. And he wasn't a phony guru that we see all the time on the internet, turning $500 into $20 million in 6 months trading secrets. This guy was a bona fide multimillionaire because he used his triple screen method. So when both momentum lines or both MACD lines are accelerating away from the signal line, only institutional money can do that. And our momentum line is green. When both momentum lines are accelerating towards the signal line, our momentum assessment is red. And this should be MACD line, I'm sorry. So when the MACD lines are not in agreement, we get a yellow assessment. Now we can add them. Now we need a red-red assessment and a green-green assessment. It creates additional specificity. And specificity is the ability to avoid losers, not get winners. You're going to get fewer trade entries, but the likelihood that your trade entry is going to work really goes up, not arithmetically, but geometrically. So with two red, price is almost always going to fall. Green, price is almost always going to rise. Elliott wave, Gann theory, all these other things aside are not going to matter because this is institutional money only that can create this kind of alignment. And it's going to push, since price is rising on your two higher time frames, it's going to rise on yours. And this is the proxy for big money. The multi-time frame assessment of order flow and the multi-time frame assessment of momentum. And here's just another example. Now it's easier to see chop. You either have red or green, and without the alignment, you got to trade short, you got to trade long and short and long. Again, there are a few more trading rules. I'm not going to have time to go into the specifics, but if you come aboard, I'm going to do a master class, and I'm going to give you, all the nuance for the system. And they also keep you in a trend. You can see when order flow and momentum stay green, it means institutional money has not left the trade. And this thing has the potential to go up, I don't want to say infinitely higher, because price always wants to regress to the mean, which is you can define as your 50 or 100 or 200 period moving average. But as long as institutional money is involved in the trade and order flow and momentum are aligned to the upside, price is going to rise. Your higher term time frames guarantee it. Again, chop. Now the last force is stochastic. And the stochastic assessment is just like the other stochastic assessments. Now, we do it a little bit differently. Now, if you look and try to trade stochastic divergence, you're really going to get beaten up. Because a divergence was a great signal before institutional money ruled the markets. George Lane invented the stochastic indicator in 1957, and he was a brilliant mathematician. And it was one of the first sophisticated indicators ever created. The only thing that existed before it was the MACD, which is a little more simplistic. Two moving averages, a fast and a slow. When the fast is moving away from the slow, you've got momentum to the upside. The stochastic is a much more sophisticated indicator. And I'm not going to go into the numbers or what it's doing, except that when the line is overbought greater than 80, we don't look for divergence. We believe
Or computers directly out of that.
I hope I'm back.
All right.
I have no idea what happened.
Yeah, you crashed.
Okay.
If you know where you are,
I
we can
do.
pick up, and I can edit out
Okay.
this little 5 minute blip and splice them together.
Okay, great. Thank you so much. I have no idea
Okay.
what happened, but it did.
Yeah.
We did blip out.
You crashed. I can tell when basically your internet dropped
Okay.
on this.
All right.
So
Well, you know, my
let me.
internet's been spotty. I'm in South Florida. It's been raining like crazy. So when both stochastic lines are overbought, we know that.
One sec here. I need to make you the presenter again,
Oh,
and
okay,
we need to
sure.
look at your
Sure.
screen here.
Am I good?
Yeah. Can you go back to the other screen here?
Uh,
Previous screen.
what screen here?
Can you go back to the previous slide? Excuse me. No, you were fine.
Okay.
Okay.
Great. Thank you.
All right.
Thank you much.
Okay.
So when both stochastic lines are greater than 80, we know that the bulls are firmly in control of the market. And when both stochastic lines are less than 20, we know that the bears are firmly in control. In between 20 and 80, we look at the position of the stochastic line and whether or not it's above or below the signal line. When it's above, the stochastic assessment is green. When it's below, the stochastic assessment is red. And when they're not in alignment, the line is yellow. So now we've got three lines. Now, momentum, which is line number 1, stochastic 2, order flow 3, you can see it gets complicated, and the analysis is more sophisticated than I've told you. So what we do is halo the candles in the analysis to make it easy. And you can see when the halo is blue, it means that order flow, stochastic, and momentum are aligned to the upside. Now you can determine the color and the thickness. I just happen to like blue. When order flow and stochastic and momentum are aligned to the downside, the candle is haloed in gold. And you can change the thickness and you can change the color. Now we go one step further. The workspace should be as clean as possible. And because all the data that you have is projected onto the candles, there's no reason to even see the 3 line. Now you can leave it up and watch it if you like. But what I do is I eliminate it. And I'm going to go back to those slides that were out of place. And here are those. Now there's no 3 line here. All we look at is the candle halo at the pivot. It's long. Candle halo at the pivot, long. Candle halo at the pivot, short. Now, for many, many other reasons, we're not going to take the counter trend trade because we do trade in the direction of the overall trend. I can't go into that much minutia here just simply because of time constraints. But like I said, if you come aboard, I'm going to show you exactly how to trade. Order flow, stochastic, and momentum really call the direction. And you can see the same thing here. There's your short entry. Now this long entry really isn't an entry. It's a counter trend trade. This short entry really isn't an entry. There's no entry because you have no alignment. And there's your perfect entry. So you get the huge moves. This move down and this move down. And that's what we're looking for. Very low risk, potential very high reward trades. Now let me go back to the end here. And let me just show you a couple of trades. Now the other thing that we use is we use an exponential oscillator. Now this oscillator is simply a stochastic raised to the second power. We want it to move fast. Every time it crosses the 50 line, you get an up triangle. Every time it crosses the 50 line to the downside, we get a down triangle. These help create terrific entries based on the software analysis. I've eliminated these. These are just telling you the market's oversold and we know now those are irrelevant and we don't care. All we're looking for is the down red and the green up. And if you look at the trades here, you can see that we've got the candle halo blue. Here's the up arrow. We're trading above the 50, and the 50 is green. That was one of the things that we needed to define, was a little bit of market structure. And you can see, up we go. Next, up we go. Next, up we go. Next, up we go. Candle is haloed in blue, oscillator entry, and we go long. Now, what is the biggest trade that takes place? It's the one that occurs right off of the mean. So the tighter the 50 you trade, potentially the longer the move you're going to get. And as you lift off the 50, you start to accrue risk. And this is what we're going to talk about in the master class that hopefully a lot of you will attend, is how to look for the lowest risk, highest reward trade setups on the chart. Here's a short, 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 all below the 50. Here's a long trade. I just made this slide yesterday. Now, the reason I didn't put the market or the time frame is this is market independent and it's time frame independent. So it doesn't matter what market this is. When order flow, stochastic, and momentum align to the upside, and the candle is haloed in blue, and you see we have a neutral candle right in here, but this is not a reason to exit, because all three lines are still green. And you can get a neutral candle. Remember, I told you that that order flow assessment is a little bit difficult to make. We have the entry right here and the move all the way up. And here's your short trade. Candle, magenta, and straight down. As long as all three lines are red, you're going to stay in the trade. And remember, you don't have to see these three lines. All you need to do is look at the candle halo on entry. So these three forces, based on a multi-time frame assessment, are really going to make a great predictor of where price is going to move off our trading chart. Like I said, I don't have NinjaTrader open. Last week we made $1,400. This week we're almost up $1,000 already. I trade futures in my live trading room, and I take every trade well ahead of everyone else. I call it out. Chart trader is projected. Stops and targets are demonstrated. And at the end of every session, I show everyone in the room, all the trades, how much we've made and how much we've lost. And we are really killing it because we respect these forces and always trade in the appropriate direction. Now I'm going to slip past this. And I really want to go to the offer, because the offer is really a lot. This is just a lot of other stuff here. Now, besides the software, you're going to get my options alert newsletter. Now, I'm quite a good options trader, and I put out an options alert newsletter, and I trade as a matter of full disclosure, every trade that I take, that I recommend, I trade live in my own portfolio. I trade it on Thinkorswim. So it's very important to me that these options work, and I take them off of a much higher time frame, the software than I showed you. I was showing you a 2, 4, 6 unit Renko. I take them off a 30 unit Renko, which projects a much longer time frame. You're going to get 1 year of that. I wanted to give you at least something to take away. I believe that now the other thing in the Options Alert newsletter is I follow small and micro cap biotechs that are coming up for FDA approval for either phase 2 or phase 3. Now these are killer stocks. Sometimes they're worth 50 or 60 cents. They get approval. They go up 200 and 300%. I work with 4 professors at the University of Miami, 1 in hematology oncology, 1 in neurology, 1 in immunology, and 1 in gastroenterology. Between the 5 of us, We look at these medicines and we make an assessment. This is part of the options alert. And I'm giving you this trade just because you attended and you listened. It's Aquestive Therapeutics, AQST, and it's a buy below $4.50. On November 29th, the FDA is going to announce whether or not their medicine is approved or denied for the oral treatment of the amyotrophic lateral sclerosis, Lou Gehrig's disease. It was the disease that killed him, took him out of his 100 million game. I mean, he played for like 10 years straight without missing a game. It's a breakthrough medicine, and based on the 4 professors I talk with, they believe this is going to get FDA approved. And I think Aquestive Therapeutics can at least double, and it could potentially triple, because it really doesn't have anything in its pipeline but potential. Now, it's sitting on a ton of cash. These are always somewhat aggressive, but the likelihood of getting a denial here, according to them, and they know a lot, is very low. So that's my little toss out to you. I haven't even put this out yet in my options alert. You're going to get a year of these picks, and we are rocking on these. I'm going to also give you a video that shows you how to trade options, how I trade options. You're also going to get a quick start guide. It'll literally get you up and running in an hour. And what I did was, if you're just starting, I made a whole list of things you have to look for before you take a long or a short. And it goes into price action, market structure, everything, to just get you acquainted if you're brand new to trading. And you always get free lifetime upgrades. If we make the system better, you get them. And our support's always VIP. We're always here 24/7. You're never going to get an answering service. Rory is here. He lives here. I have him chained to the desk. We will work with you. It's white glove formatting, and we will put you up and running, and you don't have to do anything. So the offer is $497. It is normally a lot. I'm not going to add this all up. And the other thing I forgot to mention is every month I do a coaching session, and it lasts usually like half a day. I mean, it's supposed to be an hour, and it usually goes 2.5, 3 hours, or 4 hours. Now, only the first 10 traders are going to get 1 month in the live trading room with me. We're going to trade together. Now, the offer is at rightlinetrading.com/trend3. And if you're interested, that's where you'd go. Eventually, we'll send you a link. And I hope to see you in the live trading room, where we can make some big bucks. You'd already have paid for it this week, because we're already approaching $1,000. Now, I think I have no time, but I'll take 30 seconds just to see if there's any questions. Hold on a second here. Hang on. All right, well, listen, all I can do, I just don't have the time to do it. It's great for trading Forex, Keith. Remember, these forces move price in any financial market, whether it's Forex, futures, or stocks. And just let me say the last thing, and then I'm going to close. And I'm going to give you my phone number. I'll be here for an hour. If you have any additional questions, just give me a call. If a software system doesn't call price direction on any market, on any time frame, based on the forces that it assesses, then it's broken. These have to be fundamental forces that move price. That's mathematical modeling, and that's why it's so powerful. You can trade any financial instrument on any time frame using any type of candle. It's irrelevant. We will format it for you to fit your trading style. Okay, I wish I had more time. Let me see if I have my phone number here. Let me just go right here and I'll give it to you. Like I said, you're welcome. I'll be here an hour. And Rory's also on the phone if you have any other questions. And here's our number. It's 786. It's the wrong number. It's 786-723-4656. You can get it off our website at brightlinetrading.com. Now, I hope to see you aboard, and I gave you a free trade, and I'm telling you, it's likely to be a really good winner. I'm in it, and I would recommend it really strongly. Thank you so much for having me, and like I said, if there are any questions, just give me a call. Again, thank you so much for giving me your time. Take care.
All right, we want to thank Mark for joining us. Again, the link is right there in the chat, and it'll go out with recording. So let's